The banking sector remains one of the most important sectors in the Nigerian economy. In addition, the state of the banking sector in terms of asset allocation, asset quality and capital adequacy is often used to assess the performance of an economy and the risk landscape. Afrinvest will be launching the 12th edition of its Nigerian banking sector report titled Nigeria Reopens for Business, in which it will review the performance of the banking sector and the economy in 2016-2017 and outline the outlook for 2018. Now, joining me on the show to preview the report ahead of its launch at the London Stock Exchange on Friday, the 27th of October, is the Group Managing Director of Afrinvest West Africa Ltd, Mr. Ike Chioke. Good morning, Mr. Chioke. Thank you very much for joining us on the program.
Good morning, Chimeze. Thank you for having me.
Right. In recent months, we have seen some kind of improvement in the macroeconomic conditions, and that optimism seemed to have been captured in the title of your report. What factors are driving this optimism?
Well, it's been long in coming. I think the key factors are somewhat immediately apparent. From 2014, when we began to see a drop in oil prices, and then it then took a massive drop in 2015 to, well, from about $100 per barrel to below 50, and then almost approaching 20. We've seen a gradual climb back up to in the mid-50s in terms of dollars per barrel for crude. So, but the decline in oil prices caused a massive drop in our foreign exchange income, and so you saw quarter-on-quarter earnings from exports of oil just dropped precipitously, which was then what caused, was contributory to the recession we entered into in 2016. So there was massive illiquidity in the dollar market. With the recovery of the oil price environment, we've seen a gradual rebalancing of the current account of the federal government, whereas most of 2016, they were in negative position quarter on quarter. Now into 2017, you can see a positive position, which has helped the central bank in rebalancing the economy. At the same time, the central bank has introduced several key reforms. Notable is the opening of the I&E window, the investors and exporters window for foreign exchange. And that has then brought more transparency and openness in that particular market. We've seen about $16.6 billion traded since March when that window was opened. So this is all very positive, and on the back of that, we can begin to see a more stable macroeconomic environment ending 2017 and into 2018. Right.
Now, do you have confidence in the ability of the central bank to perhaps continue with these reforms?
Well, there's always a saying about don't waste a financial crisis. I also believe that you shouldn't waste an economic recovery. And so I like to look at the market from the point of view that the glass is half full rather than half empty. I think that where we are today, if we all look on the positives, there's enough going on in the economy at large for the central bank to continue to sustain its, I would say, more market-friendly policies. Let me give you an example. It's not just the central bank that is at work here. The government itself has been very busy, and coming out of their months and months of planning, they've launched the Economic Recovery and Growth Plan. And this is supported by several plans that various arms of government have also been working on. You've seen, for instance, the Minister of State for Oil announce the 7 big wins in the oil sector. You've seen Minister of Trade and Investment talk about ease of doing business. You've seen a lot of discussions about the power sector reforms, how we can fix the power sector given the challenges we went into from the privatization. But when you look at the umbrella economic plan, the ERGP, you then realize that actually it feeds off of these various MDA plans. And if it's well implemented, then it catalyzes some of the things that central bank is doing and then points the economy towards a track of sustainable growth and expansion.
Now, so far, would you say that that ERGP has really had any impact so far?
It's very early days. Clearly, the ERGP itself is anchored on 5 pillars. The first being to ensure macroeconomic stability, and I think the central bank has done that, creditably in the last 6 months. And there's enough momentum going for it to maintain that. And then the next 4 planks, agriculture, food security, power and energy, so all the focus in the power sector and the electricity sector and oil and gas, transportation infrastructure, and last but not the least, industrialization, particularly led by SMEs. The macroeconomic work has been done, but you need to now layer on the other pillars of the ERGP. Clearly, it's a difficult one because the government is not, the executive part of government is not alone. You've got the legislature to deal with, and as you know, there's been a combative stance for the last few months between the executives and the legislatures, and you need to carry them along because some of these reforms require new laws or modifications of existing laws, so that's critical to do. And of course, as we move into 2018, one has to keep a watchful eye on 2019 when there's another election window which could put some brakes to some of these reform programs.
So how would you describe the resilience of the banking sector, particularly in the light of the recent macroeconomic headwinds?
Yeah, I think the sectors weathered the storm quite well. The bigger banks have done better than the smaller banks. We categorize the industry into two sectors: Tier 1 banks, which include the GTB, likes of GTB, Zenith, Access, UBA, First Bank, and ETI, and then Tier 2 banks, which start with perhaps Diamond Bank, Stanbic IBTC, Union Bank, and the rest. We can see from our report that the Tier 1 banks have done far better than Tier 2. Indeed, you've seen an expansion in market share amongst the Tier 1 banks from an average of about 60% of the banking sector market share to now trending towards 70% as a collective. From an earnings perspective, the Tier 1 banks have also done better. From a valuation perspective, the market gives the Tier 1 banks a much higher rating, both in terms of price-to-earnings ratio or price-to-book value. On the Tier 2 side, because it's not to say they are not growing, but they're growing at a slower pace. And they've also had more challenges because, the nature of the market is such. If you're not at the top, then the best credits will go to the Tier 1 banks, and you may be left as a Tier 2 bank struggling with the less high-quality credits, and therefore those ones are the ones more likely to have non-performing loans, which then contribute to dragging down your earnings even more.
All right, so what other policy reforms have been implemented that have actually helped to improve the macroeconomic condition and, of course, the banking sector, as you have mentioned?
Oh, the key one is the ERGP, but others are in the power sector, in the oil and gas sector, and particularly in the ease of doing business sector. I think that if they can really move forward on that, that would be quite interesting and unique. There's areas where you talk about greater transparency between the ministry, department, and agencies of government. If you can achieve that, that would be a major reform. There has been push, but again, there has been major pushback by these MDAs not to reform. Some of the noises you hear, for instance, between the letters written by the Minister of State and the GMD of NNPC kind of, crystallize that, quite frankly, in terms of the challenges of managing transparency. Other aspects would include ease of entry and exit from Nigeria for foreign business people, that we now have visa on arrival. It's still not as easy as going to Accra, going to Ghana, but at least it's possible to invite someone to come to Nigeria, and they don't have to spend months on end trying to get a visa from whichever country. We still have to do more on the port side, to decongest the port so that when goods arrive into Lagos or any other ports, it can move out very quickly. But importantly, behind all that, we still have to focus on our hard infrastructure because that's also critical.
Well, I know you're about to launch your report, but talk us through this year's report and the highlights of perhaps some of the reforms that have really impacted that sector and the reforms you think government needs to put in place to also help that sector grow.
The banking sector being sort of a window into the rest of the economy. Government, when they spend money, it first goes through the banks before it gets to the rest of us. And so you look at the banking sector as a great signal of what's going to happen to the economy. With the banks doing well profitably from coming out of 2016, already we've seen half-year numbers in 2017 are looking quite interesting. Zenith Bank, GTB, UBA have all published that they are looking very impressive already for 2017 into the 9 months. So that tells you that clearly there's been more, there has to be a flow through, trickle down to the rest of the economy. So the manufacturing sector, services, all of these with transportation, all of these will begin to do better. Particularly we saw that the illiquidity in the foreign exchange market has effectively disappeared. I mentioned earlier that about $16.6 billion has been traded in the I&E window alone. However, we see concern on the Naira market because many companies that are now recovering from the recession and want to expand their business are finding that they're lacking the Naira balance sheet. They don't have enough Naira to purchase foreign exchange in order to expand their business. So there's still a bit of an uneasy calm. Yes, we are recovering, but there's not enough growth in the system. Inflation has come down. We were at about 18% earlier in the year. We're now below 16. That's all positive. But we need to remember that once upon a time, Nigeria used to grow about 6 to 7%. It grows its GDP growth per annum. We went to a recession. It was negative. We came out of recession at 0.6. And even if all the indices are suggesting we'll be above 1%, trending towards 2%. Remember, our population is growing at 2.8% per annum. We have 180 million people in Nigeria. We'll get to about 300 million people by 2050. We need to move that GDP growth rate to above 7% again, and maybe even trending towards 10% in order to have the economic wherewithal to support the population. So
what is your expectation of the banking industry going into the new year and the economy as a whole?
We are positive. We are constructively positive for the banking sector. We will be very selective when we look at the tier 2 banks. So we'll be careful in which ones we'll take as a pick if you're looking at it from an investment point of view. For the tier 1 banks, we're largely bullish. There are one or two that may be trouble spots, but generally speaking, most of the tier 1 banks are on good momentum. And the particular reason we chose to do this event in London and not in Lagos, as has been the tradition, is also to not waste a recovery. Once upon a time, we had the 2008-2009 financial crisis. And then we came out of it with the economic management team doing a sterling job in some of the reforms. But we're too busy criticizing each other and talking about what happened, and that kind of dragged the recovery quite a long time. Now that we've come out of this recession, we want to be one of the key private sector supporters of the government to say, yes, we recovered. The glass is half full. There are opportunities. There are further reforms coming. This is time for foreign investors to come in because particularly the country needs to see more foreign direct investment. There's a lot of foreign portfolio investment, but not quite the momentum we need to have in foreign direct investment.
All right, you did mention the tier 2 lenders earlier in your talks. Now we have seen a rush for these tier 2 capital, particularly via Eurobond issuance in 2017. Now, does this validate the views that there are new lending opportunities, or could it be for the purpose of strengthening capital buffers?
It's both. Both for the purpose of strengthening capital buffers, because notwithstanding the positive performance of the industry, there were clear challenges. The foreign exchange market, you saw a devaluation of the Naira from about 200 to 305 at the CBN rate. On the power market, it went totally wild from close to 200. It went as high as 520 before coming now down to about 360. So the spread between the official market and the power market has clearly narrowed, to the point now that businesses can freely get dollars. But in that depreciation of the Naira, there were losses sustained by many banks. This is because about 40% of the risk assets of commercial banks are denominated in dollars. Now, if you then devalue the currency, then clearly you make it much more difficult for companies who are earning Naira to make enough profit in Naira and repay those dollars. So you then have more non-performing loans. So some banks suffered more than the others, and particularly among the tier 2 banks. So the opportunity now of going to the Eurobond market to raise tier 2 capital is one that should not be missed if you have the window. You've got your paperwork ready, you've got your advisors ready, and you go and do it. So that is what is happening.
All right, thank you very much for your thoughts there, and I wish you luck as you launch your report. Thank you.